Hi, Chris Lamb, mortgage banker, Redding, California. This is your February and March video blog. With interest rates being extremely low again this year, 2015, right at the first quarter, one of the main questions I get a lot is, Chris, what makes refinancing worth it? And I think that's a really important question to ask for a homeowner that's considering doing a refinance. The first part of that question that I like to try to answer is the cost versus the reward when it comes to that refinance. Now, a lot of lenders will talk about what's called a no-cost refinance, and all that really is a lender selling you an interest rate that's slightly higher than the going rate that day so that they can then give you a credit to cover the cost of that refinance. And in my mind, it's kind of a deceptive way to tell a client what kind of refinance they're getting. When you do a refinance, there are always closing costs. You're going to have title and escrow, you're going to have some loan fees, and most of the time you're going to have an appraisal cost unless you're doing a streamlined refinance with an FHA loan or a VA loan. What you want to do is you want to look at what that reward is going to be over the short term versus what the cost is going to be. For example, if that loan is going to save you $200 per month and it costs you $3,000 per month, within about a year and a half to 2 years, you're going to recoup the cost of that loan from the monthly savings of your refinance. And those economics can change depending on the amount you're going to save monthly versus the cost of that refinance. And that's something that we really want to try to determine in the first time we look at a refinance for a client is, what is their recoup period? In other words, how long will it take them over the course of however many months to save what the cost of that refinance is going to cost them? Most people that buy a home today will own their home for about 5 years. Now, there are people that keep their homes for a lot longer than that, but if you were to look at the statistic over the last 50 years, most people will either get another loan or get another house within 5 years. So if it takes you over 5 years to recoup the cost of your refinance, in my mind, it's usually not something that I would suggest a client doing. The other thing to think about is the long-term versus the short-term. Now, it's very common for people today to do a 30-year fixed product, and most people like fixed loan products versus adjustable rate mortgages. But a lot of times it's good to look at a shorter term. Most people want to retire at some point in their life and have a home that they own free and clear. In my mind, that's one of the best retirement strategies out there, is to own a house with no mortgage payment. Well, in order to do that, you're not going to want to reset that 30-year loan several times during your lifetime. And so we always like to take a look at shorter terms. Now, a lot of people think that a 15-year term is the only short term out there besides a 30-year fix, but there is a 20-year, a 25-year, and we even have a 10-year term. And so one of the things that we do at our office is we help our clients come up with a plan and look at all the different types of terms that are available, including a 10-year, a 15-year, a 20-year, and a 25-year, to shave some of those years off the life of that loan so that one day they can actually own their home and not be paying a mortgage payment. That's it for today. It's a little long video blog, but this is really important information. If this is something that will benefit you or someone you know that's thinking about buying a house, I encourage you to forward this email to them. You can share it on Facebook. And if you have any questions, you can also call us at the office, 282-1166.